Good morning, everyone. Welcome to the webinar on Impact of Budget 2024 and the recent GST amendments and the judgments on the retail industry. Thank you, EY team, for hosting this webinar for RAI members. Without any further delay, may I now introduce you to the speakers for the day, Mr. Sanket Desai and Mr. Rahul Kakkad. Mr. Sanket Desai is a partner with the EY Indirect Tax Practice. He's a chartered accountant by profession and a commerce postgraduate from Mumbai University. He focuses on consumer and the retail sector and has more than 18 years of experience. Mr. Rahul Kakkad is also a partner with the EY Direct Tax Practice. He's a chartered accountant and a commerce graduate again from Mumbai University. He also focuses on consumer and the retail sector, and he has more than 17 years of experience. We have received a lot of questions from our esteemed members. I would request the speakers to take them as and when the topic proceeds. And we'll have more questions which we'll be posting on this chat sections. Over to you, Mr. Sanket.
Thank you so much, Palak. And first of all, warm welcome to all the members. And thanks a lot to the Retailers Association of India for giving us yet another opportunity to interact with all the members and also share our insights and discuss the impact of the recently announced Union Budget 24-25 on the retail sector. And also this would be a great opportunity to share some insights on what are the recent tax updates, what could be the impact on the sector, so on and so forth. So this is going to be an interesting session. Lot of expectations were there prior to this budget, and in the next few minutes we will discuss which expectations have been met, which have been missed, and what could be the impact on the sector, as well as what would be the sector that we should be looking out for the future as far as the sector is concerned. So with that backdrop, we will start with the today's presentation. So basically what we will be covering is 5 aspects here. First is the policy announcements. So just we will touch upon the key policy announcements that have been made in the budget. Second important aspect is direct tax proposals, and we are all aware that a lot of traction and discussions have happened on some interesting amendments which have happened in direct taxes, especially on capital gains tax, indexation, and other aspects. So we'll discuss those in detail. The third important aspect is indirect tax proposals. And again, in indirect taxes, in the budget as well as even prior to the budget, a lot of changes had happened, were announced in the GST Council meetings, which also concluded in the month of July. So we will share those as well. Also, the recent GST amendments and some interesting judgments which are relevant for our retail sector. So this is broadly what we will cover in our today's session. We will first move on to the policy announcements. Before we start, the retail sector today contributes to, just to set the context, it contributes almost 10% to the GDP of our country and almost 8% of the workforce or the employment. So it's a sizable sector, and the impact on the overall economy and the GDP is substantial. And that's why it is important to lay down, to kind of marry what is the government's focus area, priority areas, with what is expected by the sector to grow. If I just look at the trends, the trend or the theme has been basically aimed at increasing the purchasing power, or this is at least what the sector also expects, that purchasing power of the consumer has to increase, and this will in turn help the retail sector to grow. The focus should be the tier 2 and the tier 3 the markets where there is a lot of scope and potential for growth still, including the rural markets. One of the areas which the sector has been asking for, and which as such has not been addressed in this budget, is basically increasing the FDI limit for multi-brand retail trading to 100%. But that is something that remains in the wish list, which is currently 51%. If I look at the broad structure, I mean, what is the main focus area of the government? Of course, the policy focus areas, there are 9 priority areas, which the finance minister also discussed in the budget, including agriculture, manufacturing and services, infrastructure, energy, employment and skilling, HRD, urban development, R&D, and the next gen reforms. If we try to see what are the key impact areas for the retail sector, the first is basically the stress on employment and skilling. So there are various incentives or various measures taken to incentivize employments in terms of direct benefit transfer for 1 month wage for new employees with a certain cap of 15,000 and applicable to employees of who have salary of 1 lakh per month. Then also certain incentivization has happened for the employers, wherein the EPFO contribution will be reimbursed to the employees. Internship opportunities in top 500 companies for at least 1 crore youth. The direct benefit transfer, which I was talking about, is expected to benefit at least 2.1 crore youth of India. So this is the first theme to incentivize employment and skilling. The second important theme is manufacturing and services. So basically to promote manufacturing and services, which includes digital public infrastructure application, MSME, Mudra loans for the MSME sector, credit guarantee scheme. So all this is to incentivize manufacturing and services. That's the second important area. And the third important area is focus on ease of doing business. Various measures have been taken towards that as well. Some of the examples are Center for Processing Accelerated Corporate Exit, for voluntary disclosure of LLPs, strengthening the NCLT, setting up additional tribunals, simplify the FDI and OI regulations to facilitate foreign investments. And also Jan Vishwas Bill 2.0, which is proposed for enhancing ease of doing business. If I just quickly cover the budget estimates, I mean, as a country, we are still in a fiscal deficit situation. However, we can see a lot of hope to move towards reducing that fiscal deficit over the next few years. This year's estimate is 4.9% fiscal deficit, and the next year's target is 4.5%. So this is also an important development. And the last piece, which was as such not expressly discussed in the speech of the finance minister, but it also finds mention in the expenditure budget, and some interesting developments. And again, this is to incentivize certain sectors in the retail industry and consumer industry. They are announcing, or they have rather recommended PLI schemes for the toy industry, footwear industry, as well as the leather sector. So this is a good development, good news. Of course, the cabinet approval is yet pending for this, but the government has recommended that they will allocate 3,489 crores for the toy industry for giving PLI benefits, and 2,600 crores for the footwear and leather sector. So we have already seen that in the past few years, other sectors in the consumer industry, like the food PLI, I mean, they have helped the sector. Similar expectations are there for the toy, footwear, and leather sector also. And the third sector is the white goods industry, wherein they had already announced the PLI scheme, but they have, I mean, the application window had closed. Now they have reopened the application windows from 15 July to 12th October. So more companies can apply for this scheme. This will basically cover AC, LED lights, those kind of products. So basically certain consumer durables will be covered. So companies who are manufacturing these products can apply for this PLI scheme. What I'm trying to say is that all these PLI schemes for toy, footwear, leather, and white goods will further help or incentivize companies to manufacture in India, and it is expected to that the benefits of these incentives which will be given to the companies will help in further increasing the demand the supply of all these goods in the country. Also, in the long term, rationalizing the pricing for the consumer and more availability of quality products at affordable prices to the consumer. So these were the highlights as far as the economy impact or the impact on the retail sector is concerned. I now hand it over to my colleague Rahul Kakkad. Rahul will take all of us through the direct tax proposals which have been announced in this union budget. Over to you, Rahul.
Thanks, Sanket, and good morning, everyone. So as Sanket mentioned, I think the government has taken several steps focused on infrastructure, manufacturing, stroke PLI, skilling, agricultural reforms, which will definitely bring the upliftment to the sector and pave the way for a sustainable growth. From a tax perspective, there aren't any big bang reforms, but if you have to look at, I think the theme was very clear. The FM laid out in the budget in terms of simplification of the income tax law. She mentioned that 58% of the corporates, can you go to the next slide, please? File have collected taxes under the new tax regime. Similarly, for individuals, two-thirds of the previous slide. Two-thirds of the individuals have opted for new personal tax regime. She also mentioned that a comprehensive review of the Income Tax Act is likely to be completed within a span of 6 months, with the objective to making the act concise, lucid, and easy to read and understand. Also, the endeavor is to reduce disputes and litigation and provide certainty to the taxpayers. As a step towards it, process has already commenced, and various changes and uh, provisions have been amended with simplification of capital gains tax regime, TDS rate structure, and the reassessment process. Moving to the next slide. From an individual tax proposal standpoint, especially the people who are in the new tax regime, there is a tinkering of the slab rates and the improvement or increase in the standard deduction from 50,000 to 75,000. There is an overall benefit of 17,500 in the hands of salaried employees, which is a welcome move, which will surely lead to probably more disposable income in the hands of the individual, which will surely bring about some boost to the sector. From a deduction and an increment to the contribution to the NPS from 10 to 14%. Earlier, the government employees' contributions were already increased to 14%. To bring private sector employees in par and in line with the government employees, there is a proposed to increase the contribution to NPS from 10 to 14%. Also, when TCS was introduced, it was already on motor cars, but previous year they also introduced TCS on foreign travel, payments for medical, stroke, college, and etc. For overseas payments. There was a TCS which was introduced. Having said that, there was a lot of representations to say that the TCS was not getting offsetted against the TDS. There are no provisions that an employer can offset the TCS, which is levied on the employees. So this move is a welcome move. Now it is allowed to say that if there is any TCS in the hands of the employee, then he or she can furnish those data to the employer and can get it offsetted against the salary. So typically in December or January, when the companies are collecting declarations from the employees, they can take a similar declaration of the TCS and the employees can avail benefit. provision is effective from 1st October 2024. However, there is one slight lacuna if you look at the technical reading of the provision, which probably says that the total amount of TDS and TCS cannot fall below the tax which can be deducted on the salary income. So one will have to wait and see if there is any clarification which has been provided by the government as we go along. Next slide. Reporting of income from house property. So there were certain individuals who are taxpayers, which the finance minister said that were claiming income from house property under the head of business and profession instead of income from house property, and thereby resulting in the overall reduction of tax liability. It is now proposed that income from let out of house property will be only taxed under income from house property and no other head. They've also introduced in terms of a new TCS on levy of luxury goods. This change is effective 1st January 25. Any goods which are exceeding value of 10 lakh rupees and the list of goods which are typically defined as luxury goods, a list will be notified by the central government. There will be a levy of TCS on at with the rate of 1% on such sales. So for the members today, if there are sales which are increasing of more than 10 lakhs, then this change is going to impact our sector. Next slide. Reporting of foreign assets. Currently, failure to report or inaccurate reporting of foreign income or overseas assets attracted penalty of up to 10 lakh rupees, regardless of the value of asset or income, with some exceptions of foreign bank account to the balance of 5 lakh rupees. Typically, we used to see a lot of employees having ESOPs or shares in the foreign company. There was a certain uncertainty around when should one disclose these foreign assets at the time of vesting, exercise, or when the option is given, and so on and so on and so forth. So to bring clarity to say that they've proposed a relaxations to say that where the aggregate value of probably foreign assets doesn't exceed 20 lakh rupees, there will not be any penal provision. So it's a welcome move, and the effective change is applicable from 1st October 2024. Moving on to the changes from a corporate tax perspective, we've kind of bucketed into three buckets: widening of the tax base, rationalization measures, and dispute resolution measures. Once we'll start with the widening of tax base, the first change is around the buyback tax. Currently, buyback tax is payable by the domestic companies at the rate of 23.3% on the buyback of shares, and the same was exempt in the hands of shareholders. Now it is proposed to abolish buyback tax, and such income will be taxed in the hands of shareholder as deemed dividend. What does that entail? There will be no deduction of expense will be allowed against such dividend income. Domestic companies will have to withhold tax at 10% when payments are being to resident shareholders. One will have to see the applicability of lower tax under the double taxation regime when the payments are made to non-residents. Cost of acquisition of shares will result in a capital loss and will be allowed as a set-off against and carry forward against future capital gains. So, as an example, if an individual shareholder has bought shares in company A at rupees 500, that's the cost. However, tomorrow, if the company decides to do a buyback at 600 rupees, the entire 600 would be subject to a dividend. So there will be a withholding A to start with on 600, and then the individual getting that 600 will have to offer that in his or her income return and on a slab rate basis. But the entire 500, which is my cost of acquisition, will be allowed to be carried forward as a capital loss and set off against the same year or the future gains in the head capital gains. So this is again a change which will have impact on the sector. Moving on, please. Capital gains, in terms of exemptions of corporate gifts under 47(3). Currently, transfer of a capital asset under a gift or a will or an irrevocable trust is not considered as a transfer for the purpose of capital gains. This exemption now will only be applicable only by such transfers are made by individuals and HUFs. Gifts by corporates will now be considered as taxable. Fair value provisions of computations of capital gains will get triggered. Cost of acquisitions for equity shares under offer of sales in an IPO scenario. On withdrawal of LTCG exemptions of listed shares in 2018, a specific provision was introduced to provide for computation of cost of acquisition, considering the FMV as on 31st Jan 2018. The provisions created ambiguity for computations of FMV of equity shares transferred pursuant to an offer for sale under an IPO. Now, the FMV for such equity shares will be the cost of acquisition adjusted to the cost of inflation up to FY 17-18. This is a retroactive change effective from AY 18-19. Moving on. Capital gains. This is the most talked about change when it comes to post the budget in terms of the whole rationalization of the capital gains regime. So in terms of what has changed, the holding periods have changed, the tax rates have changed, and certain indexation benefits which was available earlier have gone away. So let's talk about what are the changes and its impact. In terms of holding period, it has been rationalized. Thresholds for long-term treatment. Basically, listed financial assets held for more than 1 year will be treated as long-term. Unlisted financial assets and non-financial assets held for more than 2 years will be treated as long-term. The only one exception to this is in terms of an undertaking. Typically, we see this at the time of a slump sale. When we slump sale an undertaking from company A to company B, to qualify it as a long-term asset, the undertaking threshold remains at 36 months. From a rate perspective, there have been tinkers, certain rates have increased, certain rates have reduced. The long-term capital asset rates on listed shares, equity, mutual funds, InvITs, rates, etc., have been increased from 10% to 12.5%. However, they've also reduced from a peak of 20% to 12.5% for other non-financial assets and unlisted financial assets. Short-term capital gains for equity shares, equity mutual funds, etc., have been revised and increased from 15% to 20%. Short-term capital gains for others remains as usual on applicable rates. As I spoke about earlier, there was an indexation benefit which was available typically when you sell long-term assets, typically property, land, building, gold, etc. So they have done away with the indexation because they've reduced the capital gains from 20% to 12.5%. However, what they've permitted is probably until FY 2001-2 for assets which are acquired prior to 2001-2, you can replace your cost base as an FMV as on 2001 or the actual cost of acquisition, whichever is more beneficial to you. So this, assuming you've bought a property in say 1990 at 100 and the fair value is on 2001 is say 150 and you've sold the property in say 2025, then probably you can use the cost base as on 2001, which is 150 when you compute your capital gains without indexation. In a scenario where the cost of acquisition say was 150, however, the fair value as on 1st April 2001 is 100. In that scenario, given the cost is more beneficial, the taxpayer can opt for the cost itself. So it's the cost or FMV as on 1st April 2001, whichever is more beneficial to the taxpayer, can be substituted. From an impact standpoint, I think there have been rounds to make to say that indexation has gone away and the benefit will be lost and there will be more outflow. As a broad principle, I think if the property value is increasing on a CAGR of 10%, I think the newer regime or the newer tax rate of 12.5% seems to be more beneficial. However, each taxpayer is requested to compute and figure out its capital gains, at the time of the sale of property. Unlisted bonds and debentures will continue to attract capital gains at applicable rates, irrespective of period of holding. There is certain tinker, next slide, please. There is certain tinker on the STT, obviously considering the exponential growth of the derivative segment. The new STT rates are applicable from 1st October 2024. On options, it has been increased from 0.0625 to 0.1%, and sale of futures, it has been increased from 0.0125 to 0.02%. Moving on to the rationalization measures. Angel tax abolished. Currently, the existing provision spoke about, which was introduced in financial year 2020, which was applicable to companies who received consideration in excess of fair value on issue of shares to its investors. The angel tax was introduced to curb value shifting primarily between resident taxpayers initially. This caused a lot of hardship to the startup sector, who were probably in their journey were raising funds for the innovation and R&D and so on and so forth. So each round there was a lot of premium which typically they used to garner and attract from investors. Unfortunately, because of these provisions, there was a lot of trouble, unwanted litigation, which was happening by the tax department. So now it is proposed to abolish the angel tax under 56(7)(b). So this is a welcome move. Having said that, there are still certain other provisions under section 68 which talks about unexplained credits. So any fundraise, again, the department can raise inquiries under section 68. And also raising funds at abnormal premiums could also attract, we need commercial rationale and justifications from a GAR perspective. So investors and probably companies who are raising funds, while this is a very welcome move, but needs to probably address certain other issues as well, and should keep in mind when the fundraise happens. Next slide, please. Certain rationalization measures when it comes to the procedures of reopening of assessments. The government has probably tinkered these provisions. Earlier, it was 4 years, 6 years, which then got changed to 3 years and 10 years. So they've probably realized that increasing the reassessment proceedings up to 10 years led to a lot of hardship for various taxpayers to companies, because they need to maintain documentation and data up to last 10 years. So they've probably gone back to the earlier thought of 3 years and 5 years, and 5 years as in terms of a reasonable period which they believe for income which has escaped tax assessment. So this is again a welcome move. Slight changes in terms of procedures when it comes to approvals required. Earlier, approvals were required of CIT, PCIT, or CCIT. Now probably that's done away with. Probably the AO can take approvals from additional stroke joint CIT and reinitiate initiate reassessment procedures. For matters pertaining to survey, reassessment can be undertaken. For search, however, Section 148 will not be applicable, as now they've introduced the block assessment concept, which was there earlier, which was abolished. So they've reintroduced the block assessment procedure. So in case of a search happens on a taxpayer stroke company, the department will reopen the last 6 years and undertake assessment of the previous 6 years and the broken period till the search has been undertaken on the company. So that has been reintroduced. Next slide, please. They've also probably extended the scope for lower deduction certificate, LDC typically, that's what we call. Section 197 allows an SSE to apply for LDC. However, 194Q or 206, which required people to deduct TDS or TCS at the rate of 1%, 0.1% on goods over 50 lakhs, you could not go to the department to obtain an LDC. Now it is also proposed to introduce this under 197. So it's a welcome move, for companies who are probably in a loss-making scenario, trading companies who are in a loss-making scenario. and now can approach the department and get a LDC at a lower rate, and this will surely improve the working capital scenario of companies. Disallowance of amounts paid towards settlement proceedings for contravention of any law. So law has evolved in terms of, initially the language was prohibited by law, then it got changed, purpose of offense, so on and so forth. So now what they've done is they've also probably added an additional clause 4, and it reads to say that any expenditure incurred by an SSE to settle proceedings initiated in relation to contravention under any law as notified by central government within the ambit, would also likely to be get disallowed. And this is effective 1st April 25. Having said that, while notification is still awaited, and we need to see what laws will fall under these in these categories. It will be interesting to see whether, in terms of there are judgments to say if there are any regularization fees typically which were paid by companies, probably to settle, any dispute without any admitting or denial of guilt, let's say probably under a SEBI law, or probably compounding fees under FEMA, so on and so forth, whether that will probably get attracted with this. So any out of court settlement, typically there are disputes when it comes to retail companies, if with consumers basically, and you go and do an out of court settlement, whether any payments made uh, will are likely to get covered under this change. So this is something which we'll have to look at, and the notification by the central government to which acts are going to get covered should be monitored to see what kind of impact it will have on us. Second change around the TDS, a lot of changes were rationalized in terms of TDS as well. Sorry, go to the previous slide, please. Payments to residents. So one change which probably may impact our sector is around payments on commissions to brokerage. The existing rate of 5% has been reduced to 2%, and payments to e-commerce operators to e-commerce participants have reduced from 1% to 0.1%. So this is also a very welcome move, 194O. There are a lot of challenges which were faced by the e-commerce participants. They were, typically are startups or probably companies in their early growth stage. Many of them are in still a loss-making scenario. A lot of working capital was getting blocked because of this 1%. Having said that, this is a very welcome move with a proposed rate of 0.1%. Both changes, 194H and 194O, are effective from 1st October 2024. Next slide. Alignment of interest for late payment to government on account of TCS. Existing provisions spoke about a 1% interest. However, TDS always, any delayed payments were subject to an interest of 1.5%. So now to align both TCS and TDS, they have increased the TCS rate from 1% to 1.5%. TDS under 194C. Currently, there is a lot of ambiguity where some deductors apply TDS under 194C. The rate could be either 1-2% when it should apply, or 194J, either 2% or 10%, depending on whether it is FTS or FPS. The definition of work under 194C does not explicitly exclude payments that should fall under 194J. While the government rationalized and probably the rates under 194J, probably a couple of years ago. However, the dispute still continued whether the payment should fall under J or C. So now it is proposed to clarify that any payments which are covered under Section 194J, fees for professional or technical service, and does not constitute work under 194C. Having said that, again, the issue may be for composite contracts, for example, for payments to professionals, architects, interior decorators, etc. If there is a common contract, there will be still issues. So probably as a recommendation, one could still look at splitting of contracts for work as well as professional fees to avoid any disputes. Penalty for failure to furnish statements. Section 271H imposes a penalty for failure to submit TDS or TCS statements. No penalty is imposed if the person submits the statements within 1 year from the due date. They have reduced the timeline from 1 year to a period of 1 month. Penalty is likely to range from 10,000 to 1 lakh rupees. Relaxations when it comes to prosecution under 276B. 276B spoke about prosecution for delay in deposit of TDS within a prescribed time limit. There were certain internal circulars which spoke about, if there are genuine mistakes at the end of the tax, at the end of for the taxpayer, where probably the amounts are not up to 25 lakhs, greater than 25 lakhs, and delays not exceeding 60 days, they were not initiating prosecution. However, there are a lot of uncertainties around it, and there are a lot of, at times, notices for prosecutions which have increased in the last 2-3 years. What the government has now said that if the TDS is deposited on or before the due date of filing the TDS return for that quarter, then there will not be any prosecution which will be initiated. This change is, however, doesn't include TDS under 194 hours. Say, for example, for the quarter April to June, for the month of May, the due date to deposit TDS is 7th June. However, if I deposit, there's a delay in depositing it. However, if I deposit before the filing of the quarter return, which is on 31st July, so any date before 31st July, if I now go ahead and deposit the taxes, then there will not be any prosecution in the hands of the taxpayer. So this is again a welcome move, and will reduce disputes and litigation on this front. Time limit for correction of TDS or TCS statements. It is now proposed to prescribe a 6 years from the end of the financial year within which the TCS or TDS statements will have to be corrected. Time limit for passing order under Section 201. The current time limit was around 7 years from the end of the financial year in which the payment is made, or 2 years from the end of the financial year in which the correction statement is delivered. Typically, the said limit is applicable for failure to deduct or deposit from a person resident in India. No time limit was prescribed for failure to deduct from a person non-resident to area, a non-resident in India. So there were judgments which spoke about 4 years, 6 years, so on and so forth. To align everything, now they've prescribed a single time limit of 6 years from the end of the financial year. Withdrawal of equalization levy. Equalization levy of 2% on non-resident operators, non-resident e-commerce operators has been withdrawn. So again, this is a welcome move. There's uncertainty on to whom it is applicable, given the language was quite broad, and this is effective from 1st August 2024. Moving on to the last bucket of dispute resolution measures, Vivad Se Vishwas scheme, which was introduced in 2020 as well. So this was a huge success in hit. And looking at the pending litigation, which is across various forums at commissioner levels, tribunals, high courts, supreme courts, the government has planned to reintroduce the Vivad Se Vishwas scheme 2.0, wherein a taxpayer who have any appeals which is pending across commissioner level, tribunal, DRP, high courts or supreme courts, could apply under the scheme. The settlement amount, obviously, there are two buckets to it. If the scheme is availed on or before 31st December 2024, and the scheme is availed on or after 1st January 2025. Also, in terms of whether the appeal is filed before 31st January 2020, but after 31st Jan 2020, which was the earlier scheme, and on before the date of the budget, or they are pending. These are old appeals which you could settle before in the last VS2 as well, but you haven't settled. So there are tabulated in terms of a formula is given in terms of disputed amounts, what you can pay and how you can settle. What is interesting out here is that, the payment amount gets reduced by 50% in case where the appeals writ or SLPs are filed by the tax department. So if there is an appeal which is where the department has gone and the taxpayer wants to avail and settle it, the tax disputed amount can get reduced by 50%. And also where in case there is a favorable ITAT or a high court decision in the taxpayer's own case and there is an appeal which is pending now at tribunal or commissioner level, and I still want to go ahead and settle it just to buy peace, and the overall tax amount gets to the extent gets reduced by 50%. The scheme shall come into effect from the date on which it will get notified by central government. So we all are awaiting this circular. But again, this is a welcome move, and hopefully it will help to reduce, the pending litigation across various levels. Certain monetary limits, next slide please, have been for filing appeals by department, again have been increased across various levels at the tribunal, high court and Supreme Court. The rates have been increased from 50 lakhs to 60 lakhs monetary limits at tribunal, high court from 1 crore to 2 crores and Supreme Court from 2 crores to 5 crores. So department cannot go and appeal if the monetary units are below the set threshold. Lastly, digitalization of taxpayer service. While, as you know, assessment, appeals all have moved to faceless. FM also mentioned in the speech that services like rectifications, order giving effects to the tribunal appellate orders will also be get digitalized over the period of next 2 years. So they are moving to a paperless, faceless kind of a thing over the next 2 years. So that's it from my perspective, from a direct tax perspective. I'll hand it over back to my colleague Sanket, who will now walk you through the indirect tax changes as well as the recent updates from a GST and indirect tax perspective. Thank you so much.
Thank you, Rahul, for covering the direct tax proposals comprehensively and also giving very good illustrative examples for the audience to understand. I will now take it forward to the indirect tax proposals. Before we start, there were a couple of points. One was when we talk about indirect taxes, it covers two aspects: customs and GST primarily. Now, most of the GST related announcements don't happen on the budget day. Because now we have a GST council which operates throughout the year. They keep meeting and then they take decisions on aspects such as any rate changes, GST rate changes that may be happening, or any important circulars to be issued to address any disputes, controversies, so on and so forth. Having said this, there are certain amendments which have still happened which have been proposed in the budget with respect to GST as well. And I will cover the key ones which are relevant for the retail sector. The first important amendment is that the limitation period, and this is very important because now we have just completed our 7 years of GST, and the GST assessments have started now in full swing. Most of the companies have completed 2017-18 and 2018-19 assessments, and 1920 is near completion. Probably the order will be passed by the end of August 2024. So what will be relevant for going forward is to understand that from 2021 onwards, what will be the time limit for the authorities to pick up any case for assessment. And why I'm saying this is because up to 2019-20, because of the unforeseen once in a millennium kind of event like COVID-19, which happened in 2020, which was more of a global calamity. The government exercised special powers under the act to extend the timelines, because in those days, neither the assessee nor the tax department was expected to attend tax hearings or make any submissions, and that's why the periods got extended. And there were certain litigations around that as well. But now moving forward, what they have done is that they have come up with a single limitation period of 3.5 years from the date of filing the annual return. Okay, for all the cases. So earlier they used to say that if the case involves any fraud or misstatement or suppression of facts, then the time limit was 5 years. And for cases which do not involve fraud, suppression, or misstatement, it was 3 years. Okay, and there was always this ambiguity that what constitutes, in which case should this extended period of 5 years be invoked, and when it should be 3 years. So what the government has attempted again is to simplify and have a common limitation period of 3.5 years. While this is a good move because it will reduce the ambiguities and disputes around what is a fraud case and what is a non-fraud case and so on and so forth. However, the point to note is that they have said 3.5 years, and devil is always in the details. If you see, 3.5 years comes to 42 months. Okay. And then they have said 42 months from the date of annual return is the time for the authorities to issue a notice, a show cause notice to the company. And then they have 12 months to complete the assessment. So 42 months plus 12 months makes it 54 months. And there is also a provision to increase it further by 6 months. It cannot be invoked every time, but sometimes in the interest of the revenue, the commissioner may invoke special powers to increase it by further 6 months, in which case it can go up to 5 years also. So which means it can be 60 months. So for cases not involving fraud, suppression, or misstatement, the takeaway is that now the period of extension could go up to 54 months or 60 months from the date of annual return. So we should be mindful of this. Okay. Going forward, it will have an impact on any GST positions that we take, and we should know by when our case will get limited by on account of limitation period. Second is that there is always a provision. There was always a provision which said that if there is a litigation against the company, and if you want to close the case, okay, pay the tax and interest within 30 days from the issuance of show cause notice, then they can waive the penalty. That was the provision. Now they have increased that from 30 days to 60 days, which is again a good move. Uh, and there was also a provision for 10% penalty applicable in case of non-payment of self-assessed tax or collected but not paid. So 10% penalty is now applicable in case of non-payment of tax, which is self-assessed or collected but not paid. So these are some key amendments with respect to the limitation period. The second set of amendments which have happened are with respect to input tax credit, or ITC as we call it. So for the past period, that is from July 2017 to March 21, there was always this litigation around when does the input tax credit get time barred. So suppose I have availed or claimed the input tax credit little late after the due date, or after typically it was by September of the next financial year. You have to claim the input tax credit for the previous financial year. And because of that, a lot of input tax credit got lapsed, and there were a lot of litigations happening around that. Now, as a one-time relief to the industry, what they have said is that for the period from July 17 to March 21, the time limit to avail input tax credit will be considered as November 21. So any lapses that may have happened in 17, 18, 18, 19, 19, 20, you can avail the credit. If you had availed the credit up to November 2021, then it will be considered as if you have claimed it within the time limit, which is again a good move. It is favoring the industry. And the intention is to reduce litigations around this input tax credit time limit. Uh, Another important point is uh, no refund of tax paid or input tax credit reverse before the relaxation. So if somebody has actually got a refund or have paid the tax because it was lapsed then you can't get a refund of that. So this whoever have not paid till now and they are litigating, for them this benefit will be there. Also, one more favorable provision which has been introduced is that suppose you have claimed certain input tax credit, or rather, what has happened is, let's say you have purchased goods from some vendor and he has not charged you GST for whatever reason. Okay, and subsequently he gets a notice and he is assessed and he is asked to pay GST. And after 2 years or 3 years, if he decides to recover that GST from you as a buyer by raising an invoice, there was a restriction in the law that you cannot get input tax credit then, because I mean, if the tax authorities have alleged fraud, misstatement, or suppression for the supplier, if he has evaded taxes and now he wants to pay the GST and recover that GST from the buyer will not get credit. So this kind of provision was actually unnecessarily penalizing the buyer from taking input tax credit when we have actually paid the GST. What they have done, again, a welcome move, is that from 2024-25 onwards, this input tax credit restriction has been removed. So which means that if somebody pays GST late and he recovers from us subsequently, okay, even if the case involves fraud, misstatement, evasion of tax, so on and so forth, so far as he has paid that GST and raised the valid GST invoice on the buyer can now claim input tax credit. So this amendment is applicable from 2024-25 onwards. Another important and again a good move is that the reduction in pre-deposit for filing appeals. Now the old provision was that if you have to file an appeal against any order, you have to pay 10% of tax, okay, for the first appeal, and you have to pay additional 20% of tax for the second appeal. Second appeal means tribunal appeal. So total 30% of tax. That was the provision. Now what they have said is that the amount of pre-deposit for filing for the second appeal, it has been reduced from 20% to 10%. So that is again a good move, that in the old scenario, your 30% of tax would have got stuck, and it would have stayed as a receivable in your books, which is a big amount. That will now reduce to 20%. So this is the working capital benefit or a cash flow benefit for all companies. And now the tribunal appeals will really take a fast track, because as early as latest as yesterday, the GST tribunal has also been notified in all the locations. So the notification has been issued. We were all eagerly waiting for the GST tribunal to be set up, which was not set up since now till now. But now that has also been notified. So now we will be expecting a flurry of tribunal appeals which will go, because everybody has been waiting for the tribunal to be opened. And now the 10% provision will kick in. So pre-deposit of only 10% will need to be made instead of 20%, which was the old provision. Relating to this, they have also, I mean, there was also a monetary limit of 50 crores for first appeal. I mean, upper limit of 50 crores. So 10% or 50 crores, uh, whichever is lower. That was the provision. But now that 50 crores has been reduced to 40 crores. Okay. And similarly, for the second appeal, they have kept a limit of, that was also 50 crores for the tribunal appeal. That has also been reduced to 40 crores. So again, these two are important and favorable moves for the pre-deposit part. Similarly, they have introduced a new provision called Section 11A, which empowers the government to regularize non-levy or short levy of GST, which was on account of a prevalent trade practice. So, for example, some industry has taken a position based on some trade practice that their transaction does not attract GST. And this has been happening for many years. And suddenly the courts decide that no, you have to pay GST on your product. And it's an industry issue. Then the government has the special powers to regularize or to waive the GST not paid for the past period and try to make it prospective rather than retrospective. We have already seen some glimpses of this being done through some circulars which were issued. For example, the ice cream industry, which is basically selling ice cream over the counter. Earlier, there was an ambiguity whether it should be 5% or 18%. So 5% without input tax credit or 18% with input tax credit. And the matter was finally decided by the GST Council. They issued a circular which said it should be 18%. But at the same time, the industry said that if you are asking us to pay 18%, it will be a huge impact for the past period because we never collected 18% from our customers. So we will be out of pocket by 13% because we have collected only 5%. So the government said that for the past period, if you have paid 5%, that's also fine. We will not ask you to pay the balance 13. So those kind of announcements have happened in the past in a few cases. Now they have officially brought in a section to empower the GST Council to do such kind of amendments or give relaxations for the past period. This is only applicable to industry issues where there has been a genuine industry practice of GST rate or non-payment of GST. Okay, some other amendments. As you all know, the GST tribunal has just been set up, but there were a lot of commissioner appeals or the first appeal order which were waiting. They were passed, but we could not file tribunal appeal because the tribunal was never set up. And there was a confusion that from when this time limit for filing the tribunal appeal will start, because companies wanted to file the tribunal appeal, but they were not able to file because there was no tribunal. Now they have said that the 3 month, so you have to file a tribunal appeal within 3 months from the communication of the order. Now they have said that 3 month time limit for filing appeal before tribunal, it will start from a date to be notified. So it will not start from today. They will notify a date. Now the GST tribunal has been set up. So soon we will expect another notification wherein they will say from this date, the 3 month time limit will start. So from that date, within 90 days, companies will be required to file a tribunal appeal. Second thing is that in GST, summons or investigations have now become a very, very common feature. Many companies have been asked to attend for summons, and notices have gone to very senior officials like directors, board of directors, promoters, and so on and so forth. And there were a lot of practical issues in attending to all those summons in person because the officers were issuing these summons directly to the senior person in the organization and at multiple locations. So it was difficult for the person to travel and attend and was creating a lot of practical issues. And they were not even allowed to appoint any lawyer or a consultant or a chartered accountant to represent them before the officer because it's a summons. Summons has to be attended by the same person. But now, for the first time, they have said that even authorized representatives can appear for summons on behalf of the company. So this will kind of give that relief to the industry, wherein they can appoint third-party consultants or even advocates or lawyers who can go and attend on their behalf before for the summons proceedings. Again, a welcome move. Also, transitional credit. So this is a 2017 issue wherein ISD invoices or input service distributor invoices, if they were issued prior to 1st July 2017, that is the date of GST introduction, there was an ambiguity. Now they have said that transitional credit related to pre-GST ISD invoices will also be allowed. So this is again intended to address the old litigation on transitional credit. Apart from that, the time of supply for reverse charge services from unregistered suppliers, they have said that it should be the date of self-invoice. So So which means that suppose I have to pay GST under reverse charge, uh, and if there is a delay from my side in payment of reverse charge GST, let's say I've paid it after 1 year, uh, uh, the department was saying that you have paid this late, so now you will not get credit. Okay. But what they have now said is that the time of supply for such shall be the date of payment or the date of self invoice. So, which means once I issue the self invoice, I can claim credit, and that will be treated as the time of supply. Of course, I have to pay the interest if there is a delay from my side in raising the self invoice. Interest should be paid, but they have also introduced provision to say that input tax credit will also be allowed. One typical or very, very peculiar amendment which may not apply to all industries, but very specific to the alcohol industry. So in alcohol industry, there was a big issue of, I mean, we all know that alcohol is not covered under GST. It's outside the scope. And that's why alcohol industry is not eligible for any GST input credit. But what they have now said is that, and one of the key raw materials for alcohol industry was called as undenatured extra neutral alcohol, or it is popularly called as ENA, which is one of the important raw materials for manufacturing alcohol. And that was under GST. So everybody was paying GST on purchase of ENA, but that GST was becoming a cost because the final output, which is alcohol, was not under GST. And this was a big industry issue. And now they have, in fact, brought in a provision to say that ENA will also be outside the GST net, which means GST will not apply on purchase of the ENA, neither the raw material nor the output. Uh, Similar to income tax, Vivad Se Vishwas scheme, they have kind of tried to introduce a amnesty scheme for GST as well. This is for the period 1st July 2017 to March 2020. So 3 years, 17, 18, 18, 19, and 19, 20. The scheme is fairly simple. What they are saying is that you have to pay the tax, and interest and penalty will be waived. So entire tax has to be paid. Uh, However, there are a couple of points to note here. First is that uh, if the notice or if the litigation is under Section 73, then only you are eligible. Section 73 means not relating to fraud, misstatement, and suppression. So if there is a litigation going on where the authorities have alleged fraud, misstatement, or suppression, then this amnesty cannot be availed. Okay. Now the next step is that if any company has any such cases, okay, we should review them. If there are any cases where fraud or misstatement has been alleged, we can even approach the authorities and ask for early hearings, fast track of the hearings, and try to get that fraud allegation dropped and get a revised order without alleging fraud or misstatement. And then thereby, if we can explore the amnesty scheme for such years where we can pay the full tax and interest penalty can be waived. Uh, that is the first point or takeaway or the next step. The second important point is that if somebody has already paid the interest and penalty, then that is gone. I mean, you can't claim a refund of this. Uh, Companies who have already paid this won't be getting the benefit of this scheme. This scheme is valid up to March 2025. So we still have around 8 months to go to take the full benefit of this scheme. And it may seem that only interest penalty is waived, but the interest element for most of these years almost is equal to the tax amount. Okay, because it's been almost more than 5 years since this demand has come. Right. So the interest is almost equal to the tax amount, and penalty also is a percentage of the tax. So there is still a substantial benefit. If the on merits we believe that the case is not very strong and we want to close the matter, this is a great opportunity. We move on to the next section, which is customs amendment. On customs, what they have done is again, the theme is Make in India, support domestic manufacturing, enhance local value addition, promote exports. And if we look at the rate changes, customs rate changes that they have introduced, they have tried to reduce the customs duty rates for the key raw materials which are used for manufacturing in India. But at the same time, they have tried to increase the customs duty rate for direct import of finished goods. So they are discouraging direct import of finished goods, and at the same time, they are encouraging import of raw materials, which means they are encouraging manufacturing in India. Okay, so customs duty rate rationalization has happened for many products, wherein the rates have gone down, and a lot of them relate to even the consumer industry. Some of the big examples are mobile phones, where the customs duty has been reduced. Charger of mobile phones is another example. Gold, silver, you would have already heard. Gold, silver, platinum are some other examples. So those kind of amendments have happened. Also, some customs duty rate for some cancer-related drugs has been. They have extended the customs exemption for 3 more types of drugs relating to lung cancer and some other types of cancers. So, some very good amendments which have happened on the customs duty rate rationalization. The government will also be doing some study over the next 6 months to see further changes, because there will be more changes coming in on customs duty. What we have tried to do here is we have tried to put in certain products which could be relevant for the consumer sector, wherein the customs duty rate has been reduced. So one is where one of the raw materials for use of spandex yarn, where the customs duty rate has gone down from 7.5 to 5. Then some raw material used in the textile or leather industry, the custom duty rate has gone from 10 to 0. Also, certain additional accessories and embellishments for textile and leather again. It for earlier there was a customs duty, now it is exempted. Also, some more products relating to garments or apparel industry, which is for export purposes. They have reduced the rates from 30% to 10%. Gold and silver, we already discussed gold, silver, platinum, mobile phone, and chargers and adapters. Okay. Now that we have covered the important budget-related amendments, we thought we could also cover the other amendments or announcements which have happened in the month of July itself, the 53rd GST Council meeting, which happened in the month of July 2024. So we have tried to summarize some of the key points. Before we get into the actual amendments, we have covered some recent trends, which we already discussed in the last few minutes. First, these authorities are obviously trying to initiate notices based on specific issues, judgments. They are issuing summons, personal penalties. So these are the recent trends. Detailed reviews are happening through state level audits, data analytics, because the tax department now has a lot of information, transaction-wise data. They are comparing your GST returns with income tax returns. They are comparing last year versus this year. They are doing a lot of trend analysis, and then they are asking those intelligent questions as well. They are also asking for state-wise maintenance of books, financial statements, trial balances. So digital tax administration is being used to its full extent. That is the theme, and this will continue. We have already seen a flavor of that in the first 3 years of assessment, that's 17, 18, 18, 19, and 19, 20. And this will further intensify from 2021 onwards. What are the top 4, 5 litigation subjects or areas? One is disallowance of credit on post-sale discounts, and I have covered a specific slide on this in the next couple of minutes, which we'll discuss at length. Penalizing the recipient for unpaid taxes without even investigating the supplier, where so this is basically the input tax credit disallowance which happens where supplier has not paid the tax. Reconciliation related issues are very common. GSTR 1 versus 3B, all those e-way bills versus GST returns. Okay. legality of order where amount mentioned in SCN is less than the amount demanded in the order. So invariably they issue a show cause notice and subsequently they in the order the demand also increases sometimes. So this has also happened. Uh, Disallowance of input tax in respect of repairs, renovation, civil construction. So that is one key area which they are focusing on. Other litigation issues include fraudulent availment of input tax on fake invoices. So a lot of articles still floating on fake invoice rackets being unearthed, discovered, and strict action taken against that. Mismatch in turnover, income tax versus GST returns. We already discussed that. Uh, then 180 days, if you don't make 180 payment within 180 days to your supplier, then they are reversing input tax credit. Uh, Related party transaction is another favorite subject of the tax authorities. And if you have not paid to the vendor, then input tax credit is being denied. So these are some of the top 10, 7, 8 points which we should be prepared as industry or as companies, because these are the questions which are already there in the minds of the tax officer, and they are going to ask these questions. So when we prepare for assessments or litigations, we should prepare on these basic grounds before even starting the assessment. Some of the important amendments, one is on corporate guarantee. Corporate guarantee, what they have said is that if there is a corporate guarantee given between group companies, then the valuation rule is 1% of guarantee amount per annum. However, where full input tax credit of that GST is available, then whatever value is declared will be accepted. So for industries where which are engaged in 100% taxable products, this may not have an impact. But certain industries where there is exempted product, for example, let's say the diaper industry, or not diaper, but sanitary pad sector. Diaper is of course under 12% GST, but sanitary pads is one example where GST is exempted. So if such a company gets a corporate guarantee from its parent entity or a group company, then you have to pay 1% of the corporate guarantee amount is treated as the value of service, and on that you have to pay 18% GST. And this point is being picked up by the tax authorities. So there are a lot of investigations happening on this subject. One important amendment is that if you in the past, if there have been any instances of delay in payment of GST, but and you still had some balance in the electronic cash ledger, then interest will not apply. So you can take benefit of this. Uh, no GST leviable on accommodation services for minimum continuous period of 90 days, having value up to 20,000 per person per month. This may not directly impact our revenues, but if companies are sending their employees for work or for assignments or visits to other states, maybe for 2 months, 3 months, other locations, and if they are staying in a hotel, okay, then you can plan around this, because otherwise the GST credit on such expenses many a times becomes a cost. It's not available. So you can take benefit of this considering the GST exemption up to a certain limit. For appellate tribunal, they have prescribed the guidelines for recovery of outstanding dues until the appellate tribunal comes into operations. Tax, and there are certain procedural amendments with respect to appeal to appellate tribunal. Taxpayer can navigate to the steps prescribed for payment of pre-deposit, avail the benefit of stay, and we have to file an undertaking before the officer confirming that we will file an appeal before the tribunal once it is constituted. So these are some steps to be followed if you have any matters which are pending, which are for which you have to file a tribunal appeal, but tribunal is not yet set up. Then what are the steps to be followed is what they have notified. Okay, last few points. Notice and order for demand. So what they have said is that if where the demand is already paid through DRC 03 instead of credited through electronic liability register, the person may file an application in DRC 3A. Time limit to claim input tax credit basis self-invoice. This is what we already discussed. Post-supply discount. So if you are giving post-supply discount, now they have issued a circular saying CA certificate is now mandatory. So this is an important point to note. CA certificate will be required if you are issuing a GST credit note to your customer. And if it is not there, then the GST credit note will be disallowed. So you will not get a deduction for the GST credit note. Loan granted to related parties, again, a good clarification where loan is extended, it does not constitute a service. Valuation of import from related parties, they have said where full input tax credit is available, they will accept the value. So they will not harp upon the fact that it should be the market value, because anyways, whatever GST you pay, you will get a credit. So it is a revenue neutral exercise. There is no loss to the government. For warranty, they have clarified that if you are issuing any free goods under warranty, you don't have to reverse any input tax credit. With respect to ESOPs, what they have said is that if any Indian company employee is getting ESOPs from the foreign company at a discounted price, and let's say the foreign company is recovering that cost from the Indian company, that will not be treated as a service and there will be no GST on that. Last point is in case where billing address and delivery address are different. If you are billing B2C or to an unregistered customer, like you are selling to consumers who are not registered, the place of supply shall be the delivery address as recorded in the invoice. So there was some confusion around that as well. So which has also been clarified. Some GST rate changes we thought are important for the consumer retail sector, wherein they have reduced the GST rate for cartons, boxes from 9 to 6, I mean 18 to 12 in short. Milk cans also from 18 to 12. And similarly, solar cookers also they have reduced from 18. So these are some GST rate amendments effective from 15 July. The last point which we wanted to cover were some few important judgments which can be considered in your litigation, GST litigation, so on and so forth. First is that if you are issuing a post-supply discount, or let's say if you're getting a post-supply discount from your supplier, and if he has issued you a financial credit note, then there have been notices issued saying if you have received a post-supply discount, that's your income and you have to pay GST on that. And now there is a High Court decision which says that this should not attract GST because it's not an income. It's basically a reduction from my cost, and it will go against the fundamentals of the GST law. GST cannot be levied on such discount received, post-supply discount received through financial credit notes. Second good judgment is from the Kolkata High Court, wherein they have said that if your vendor has charged you GST and the department has not, they are disallowing that input tax credit to you because the supplier has not paid the GST to the government, then the tax officer is under an obligation to first check with the supplier and go behind the supplier and recover that GST from him, and not straight away and arbitrarily disallow my input tax credit. So this is also an important judgment which can be quoted because GST input tax credit disallowance and reconciliation issue is live issue for most companies, 99% of the companies. Another important judgment is which we can make use of. Suppose you have a show cause notice, let's say for 10 lakhs rupees, and subsequently there is an order for, let's say, 20 lakhs rupees. If there is a substantial increase in the demand as per order versus demand as per show cause notice, then it can be challenged. There is a High Court ruling which says that it cannot be sustained because the demand as per show cause notice, the order demand as per order cannot exceed the demand as per show cause notice. Uh, okay, one more decision of the Kerala High Court, wherein this is actually a negative one, wherein we discussed few minutes back that because of COVID-19, the limitation period for issuing notices was increased. Uh, okay, and some companies even challenged that, saying that you can't increase the limitation period. But the courts have upheld that. Extension of the limitation period for this limited period of COVID only because it was a natural calamity, and they invoked the force majeure provisions. But such kind of extension should not happen in future. I mean, it was only for a specific period of COVID, but it was challenged by some companies, and then the courts have finally said that the government was right in extending the period for the COVID period. The last decision is that if you are basically uh, giving foods to, I mean, food supply of food to your employees while they are working and charging a nominal amount for the supply of food in the canteen and giving a canteen facility, then the deduction of nominal amount by the applicant from the salary, would also be considered as supply. So on that, GST has to be paid. However, input tax credit will be available to the company in the respect of the facility which is obligatory under the Factories Act. So, I mean, this is a point to note where nominal amounts are charged. Then we need to be careful about the GST payment and framing the policies. So, this was a summary of the key amendments which have happened. Uh, I will now move on to the last part, which is some questions, and I will read out some of the questions which uh, were circulated. Uh, there were a couple of questions relating to capital gains tax and amendment in the Income Tax Act. I think my colleague Rahul has already extensively covered the impact of capital gains tax in his session. But Rahul, maybe you can just quickly summarize the impact for the industry.
Sure. So as I said, I think three changes in terms of the rates or the holding period. Listed shares, listed mutual funds, 1 year. Unlisted shares and other financial assets. 2 years is anything about 2 years will be classified as long term. Slum sale undertaking 3 years and above will qualify as long term. The rates have been increased from 10 to 12 and a half and reduced from 20 to 12 and a half. Short-term capital gains on equity, mutual funds, etc., have been increased from 15 to 20%. For other short-term capital assets, slab rates as applicable. Indexation is done away with. However, the taxpayer can, for properties acquired prior to 2001, can adopt fair value as on April 1, 2001 instead of cost, if that is more beneficial.
Yeah. And Rahul, one related question to this was that do you think this action of amendment will help in boosting the consumption of the retail industry, which it is waiting for? What is your take on that?
I think there's a slight increase overall, but in terms of long-term capital gains for the people who trade more on the stock exchange, etc. But if you see the overall rationalization of the slab rates, increase in standard deduction, allowability of TCS as a set-off against TDS, you know, and a large drop in 20% to 12.5% for non-financial assets. I think that overall it's surely going to increase the overall consumption, disposable income in the hands of the end consumer, and surely boost the retail store consumer sector in a long run basis. Also coupled with the various factors the government is taking towards investment reforms in manufacturing, skilling, infra, etc. So various factors put together will surely lead to boost consumption.
Yeah, I agree with that, Rahul. Uh, Overall, one of the questions was that what is the budget impact on the retail sector? And Rahul has very well articulated that. Uh, but I will also try to cover what are the expectations or what is an unfinished agenda, so to say, uh, for the retail sector. Uh, couple of points. One is that, of course, we discussed about 100% FDI, multi-brand retail trading, which should be allowed. And there are developed countries like China, Russia, Singapore, and even Thailand, for that matter, which already have 100% FDI. So that is one thing which the industry is waiting for, because that will bring in the investment and the technology in India and make the retail give a real boost to the retail sector. Apart from that, when we talk about GST or indirect taxes, there are still a lot of rate disputes, GST related rate disputes on what should be 18%, what should be 12%. And even the rate structure for GST is very wide. It covers 28, then 18, then 12 and 5. So one clear expectation is rate rationalization, wherein we would look forward to reducing so many slabs and make it combine probably 12 and 18 into a single rate. Uh, okay. Also, other aspect is one of the main issues of the retail industry is that they keep investing in new stores and new renovating their existing stores. Okay, so whatever the cost is incurred for the repairs, renovation, construction, etc., the GST becomes a cost. And if you look at a manufacturing company, what is their main capital, which is plant and machinery. Similarly, for the retail sector, the most important asset is the retail store. And if you don't allow GST credit on that, that really impacts and hits the sector. The retail sector should be carved out and there should be some GST credit relief which should be given to the retail sector. These were some of the takeaways. Of course, the other point was on this GST credit note where CA certificate requirement has been made mandatory, which is going to be a pain point, let me tell you, because to get so many CA certificates from every customer is going to be a great Herculean task and a lot of practical issues. And mostly then this will drive companies to go for more financial credit notes rather than GST credit notes in future. So these were some of the takeaways and impact for the retail sector. Uh, we really hope that this session we have tried our best to address the questions and the impact on the retail sector and try to make it as relevant for your sector and at the same time balance it out, not get into too much of technical jargons or judgments and all. If there are any questions, please do let us know. You can always reach out to us even after this session, and we'll be more than happy to address those. And at the same time, we look forward to having similar interactions with you, because this is just the beginning now with the Vikasit Bharat kind of mission which has started. There will be more progressive changes, more amendments coming in the direct tax part as well as indirect tax. We can hope to see DTC in future. We don't know. We'll have to wait. Similarly, for indirect taxes also, there will be a lot of amendments happening. So we look forward to interacting with all of you in future for this. And once again, thanks a lot to Retailers Association of India for giving us this wonderful opportunity and platform to interact with all of you. With on that note, we will sign off and we can conclude our today's session. Thank you, everyone.
Thank you, everyone.